if you take a life insurance that first of all covers you from the moment that you have it and provides something guaranteed in case something happens to you, but it also provides another option in your retirement that you don't have to pay taxes on, would that interest you? Probably, I would think. I mean, hey everybody, Matt McKay, Safeguard Insurance. I'm excited to bring you episode 3, not 6, but 3, I guess, of the IUL series, talking about Index Universal Life. We've already talked about what is IUL. That will be episode 1. I think that's probably a good place to have started. We talked about some pros and cons. Let's not pretend like we're in a unicorn world where everything works out and this product is everything you ever need, and I can't believe you haven't done it yet. There are pros and cons to every situation. Every person has a different thought process. Every person has a different set of finances and situations that they're concerned about. But an IUL can be a very good vehicle to help you in your retirement and in your estate planning. Now, for this episode, I want to talk more about basically. I don't want to be condescending or anything, but I want to dumb it down a little bit. Maybe you've watched the first 2 episodes and you're like, I don't know what's going on. I have no idea. So let me slow it down and make it a little bit more simple in this episode. Okay? We'll call it IUL for Dummies. Okay? And hey, for those of you that can get a little offended, I do apologize. You're not a dummy. You're just learning. Okay? But seriously, it's just to help you out in case maybe you need it broken down a little more simply than here's all these numbers and this is how this works and these are the pros and cons and let me use a bunch of big words. Well, let me use a little bit more simple language to be able to explain it. And so, Index Universal Life, it sounds complicated. Okay? Really, it's life insurance. Okay? Number 1. We get all wrapped up in all these different kinds of definitions and all that stuff. Ultimately, what do you need first? If you get something, you want to make sure that it does something for you no matter what. Every life insurance has a death benefit. Basically, when you die, your family, your beneficiary, whoever, your church, whatever it is going to get a certain amount of money to pay to move on from you, to be able to get you buried, to be able to pay off debts, pass things on to heirs, give it to the Lord, whatever. Okay? That's number 1 with Index Universal Life. That's the number 1 purpose. Now, it is something that can help do other things. Okay? And that's where Index Universal Life, IUL, can be more complicated. So, how do I explain that part? Well, if you've got all of your money in your retirement at work, all that money, when you draw it, is taxable. Well, if you take a life insurance that first of all covers you from the moment that you have it and provides something guaranteed in case something happens to you, but it also provides another option in your retirement that you don't have to pay taxes on, would that interest you? Probably, I would think. I mean, if you've just got your 401k and that's your only option, well, whenever you need something, you got to pay taxes to be able to do it. Also, if you're a little younger, maybe you don't know this. If you pull out of your 401k under 59.5, or if you pull out of an annuity or something like that, or some kind of investment tied up, you're going to pay a 10% penalty and still pay taxes on it. In life insurance, whether it's whole life or universal or whatever, you're not paying that penalty. You pay maybe loan interest, which is much less than 10%, and it's you don't have to pay taxes on it either. It provides another option for you. To make it simple and try to explain how the universal life works in general. There are different buckets, and you do need to understand a little bit about it. Okay, you don't have to understand everything, but have a basic idea of what's going on. In whatever universal life policy you have, it's going to have a bucket that's either interest, like flat interest, like 4 or 5% usually, and it just is guaranteed to get that much interest on the policy. Now, that's not just pure 5% interest on your cash. There are charges that come out called mortality charges and all that come out of that cash value that make it not a true 5% growth. Okay? So don't get too caught up in, wow, that's 4%. Woo! I got to put all my money in that. Well, you got to pay attention, because that's not exactly, it's not really 4% on your money, period. It's 4% on the growth, but there are also charges that come out. So it doesn't end up being a full 4% or whatever percentage. Index universal life is something that has an index of the market. So as soon as you hear market, whenever I'm presenting universal life insurance, I hear, oh, I don't want to be in the market. That's not what that means. It just means that you're getting a percentage of whatever the market does without being tied into the market. So if the market goes down in an index universal life, you're not going to lose any of your cash value. And in some of them, you may be guaranteed to get like a 0.5% or 1% or 0.75% or something like that. You're guaranteed to get a little bit. And then a lot of them will have some kind of cap where basically between 0 and 12% or 15% or whatever, you're going to get the full gain or a percentage of the gain of whatever the index does. Okay? And once it goes over the cap, you're capped out and you can't get any more than that, say 15%. Some of them did not have a cap, and so you just get a percentage. If it does 40%, you get 40%. If it does 0, you get 0. If it does 8, you get 8. And so that can be a really nice option there. You know, imagine, where are you able to put money in and guarantee principal, or guarantee that you're not going to lose money, but also get a huge gain year to year? Not many places you can do that. One way is IUL. Okay? And so when we think about IUL, don't make it too complicated. Okay? Don't freak out when you hear all these numbers and all this stuff and you see an illustration that's like 50 pages long and all that. You don't have to know everything. Just know, when I put my money in, I need to watch it. I need to talk to my agent. I need to consider how I'm funding it and look at the projections and understand, when I'm told that this shows an average of 7%, it may not do 7%. It might do 3%. It might do 0%. It might do 10%. Okay? So am I okay with how this does in each of these possibilities? And how likely is it that each of these possibilities happens. Okay, and that's something a good agent can help explain. But sometimes we get things so complicated that we miss out because we just don't understand. And I wanted to take the time to try to explain it a little bit more easily and encourage you. If you don't understand everything fully, that doesn't mean that you can't do it or you shouldn't. It just means make sure you get the basic idea and you have good resources available. Hopefully a good agent that will take care of you and make sure that you maintain this over time. So wanted to say that. I hope this episode helps those of you that might be struggling with all the terms and everything. And maybe this helps make it a little bit easier for you and your family to understand. Thanks. Bye.